Every day, you hand banks your paycheck, your savings, your cash. But have you ever asked what actually happens next? Is your money just sitting in a vault? Or is something far more interesting happening behind that counter? In the next few minutes, you'll see exactly how banks turn your deposit into serious, steady profit. It starts simply. Your paycheck lands in your account. Just an ordinary deposit, nothing unusual at all. You hand it over, the bank tucks it away, your balance updates. You walk away without a second thought. To you, it feels like your money is just sitting there, safe and still. The bank sees it very differently. Multiply your deposit by thousands of customers, and the bank ends up holding an enormous pool of cash. All of it gets pooled together behind one heavy vault door, looking simply stored and untouched. But a locked vault earns nothing. Idle cash is wasted opportunity. The bank needs a smarter plan. So the vault reopens. That same pooled money is about to go right back out into the world. A different customer, wanting to buy a home, is handed a loan, funded by deposits placed days earlier. Papers signed, loan approved, keys exchanged. A deposit just became an active, interest-earning loan.
The bank pays you a small rate for your deposit, often just 1% a year. That's the cheap side. That same money gets lent out at a much higher rate, sometimes 7% or more. Same dollars, different price. That gap is called the net interest margin, the single biggest source of profit for almost every bank. This same trick repeats everywhere. Someone wants a new car but can't pay $30,000 in cash. The bank approves an auto loan, funding the car today in exchange for repayment plus interest over time. Every monthly payment chips away at the loan, and part of it is pure interest for the bank. Credit cards work the same way, just faster. Every swipe is technically a tiny loan from the bank. Miss the due date and interest kicks in immediately, often above 20% a year, among the highest rates around. Check your statement and there it is. Multiplied across millions of cardholders, this becomes hugely profitable.
Businesses need capital too, to expand, buy equipment, or cover payroll during a slow season. The bank funds the request directly. In return, the company repays the loan, plus interest, on schedule. These commercial loans run for years, giving the bank a steady, dependable stream of interest income. Interest isn't the only trick. Pull cash from an out-of-network ATM, and a small fee gets deducted quietly. Overdraft charges, monthly maintenance fees, wire transfer costs, small amounts, easy to overlook in your app. Multiply these tiny fees across millions of customers daily, and they add up to billions in guaranteed income. Bigger banks go further. A company wanting to raise money or go public turns to an investment bank. The bank arranges the deal, issuing new stock or bonds and connecting the company with investors. For orchestrating this, the bank collects a hefty fee, a percentage of the total raised, often enormous. Banks also play global markets. Currencies shift by the second as money flows between countries nonstop.
Trading desks buy and sell currencies, bonds, and instruments simultaneously across these fast-moving markets. Even tiny price differences, captured at enormous volume, add up to another steady stream of profit. For wealthier clients, banks offer wealth management, an advisor who builds a plan to grow your money. That plan spreads your money across stocks, bonds, and funds, balancing safety with growth over time. In return, the bank charges a small yearly percentage of assets managed. Tiny per client, huge at scale. Now, the biggest moneymaker? The mortgage. Almost nobody can pay for a home in cash up front. The bank hands over the full amount as a mortgage, repaid with interest over 15 to 30 years. Across 3 decades, total interest paid can actually exceed the original price of the home itself. Every loan is really a bet that the borrower repays on time with interest. Usually that bet pays off. But sometimes life intervenes. Job loss, medical bills, and a loan stops paying interest entirely. That's why banks assess risk and diversify across thousands of loans, so defaults never sink the bank.
Back to deposits. Money flows in from thousands of customers,
pooling into one shared reserve daily. Regulators require banks to keep a small percentage of deposits locked away, always available on demand. That locked slice protects withdrawals. Everything above it is free for the bank to lend and earn on. Here's the fascinating part. Deposit just $100 and it's about to do far more work than expected. The bank keeps a small reserve, lends the rest, and that money becomes a brand new deposit elsewhere. That cycle repeats again and again, rippling your original deposit far beyond its starting value. Zoom out and every stream flows in at once. Loans, fees, investing, and trading all together. None of it happens alone. It compounds together into enormous, steady profit year after year. Some profit gets reinvested, and the rest is paid out to shareholders who own a piece of the bank. One more player sits above it all, the central bank, which sets a base interest rate for the whole economy. When that base rate rises, mortgages, car loans, and credit cards all get more expensive to borrow. When it falls, borrowing gets cheaper, and banks adjust their own rates and margins accordingly. Here's some reassurance. Your deposit is usually protected the moment it enters an insured bank. Even if a bank struggles, deposit insurance covers your money up to a set legal limit. This safety net is exactly what keeps everyday customers confident enough to keep their money in banks. But confidence is fragile. If a rumor spreads that a bank is in trouble, people rush to withdraw. If everyone withdraws at once, even a healthy bank's reserves can get stretched dangerously thin. Strong reserves and deposit insurance exist precisely to stop panic before it spreads out of control. Today, banking barely needs a branch at all. Most customers manage everything from an app on their phone. Fintech startups now compete directly with banks, often undercutting them on fees and transfer speed. In response, traditional banks are racing to build their own slick apps and digital tools to keep up. So what can you actually do? Start by comparing interest rates before choosing where to deposit your money. Read the fine print for hidden fees. Monthly charges and overdraft costs quietly eat into your balance. And, whenever possible, pay your credit card balance in full. It's the easiest interest charge to avoid. So here's the whole picture. You deposit money, the bank lends it out at a higher rate. That's the core. On top of that, fees, credit cards, investment deals, and global trading each add their own layer of profit. Together, it's a business built entirely on trust, turning deposits into loans and loans into profit. Next time you open your banking app, you'll see it differently. The first domino in a long chain of profit. Lending, fees, investing, trading, all working quietly together, turning your trust into steady growth. Thanks for watching. If this finally answered how banks make money, share it. See you next video.